So wanted to welcome everyone to our Nonprofit Insights webinar. This is something we haven't done a whole lot of, but it's an idea that we hope we can do more of these going forward, and we're always open to your feedback of topics that would be good to cover. Today we have an action-packed session, so you probably saw that we have a lot of content to cover in a relatively short amount of time. So we'll make our introductions very brief. And for those of you that know me, and I saw some of you on there that did, you'll probably be fine with that because you've probably learned that I'm really not that interesting of a person anyway. So I don't have a whole lot to talk about. But my name, for those that don't know me, my name is Travis Simpson. I'm an audit partner here with Hanson Weeble. I've been here for about 20 years, going on 20 years, and I work heavily in the nonprofit sector. Hanson Weeble as a whole, we serve about 160 nonprofit clients, and they're from all sizes, small to very large nonprofits. We offer a wide range of services, from advisory services to assurance services. I'm joined today by Monte. I'm glad that he's able to participate today. Monte's a manager with us, and Monte, you just want to say a couple of things?
Monte Glanzer, as Travis mentioned, I'm an audit manager at Hanson Weeble. I've been with the firm for a little over 12 years. And I too, my core base of clients is rooted in nonprofit industry. And so just happy to talk through some things and hopefully give a little insight to your organization, or at least start a conversation going forward.
All right, thanks, Monte. So I was looking at the attendee list a little bit last night, and I did notice that we have a wide range of nonprofit representatives on the call today, and some are with some smaller organizations that are looking to grow more, and some that are on the call are with very large organizations. But despite the differences in size, we all know that each nonprofit faces unique challenges. So at a minimum here today, I hope for those that already have some experience with the topics that this will at least be a helpful refresher for you. It's not often we get to stop and take time out of our day just to think about these types of things, because we're we get caught up in the day-to-day hustle. So in the event, though, in the worst case scenario, you don't learn anything. I figured Thanksgiving was coming up, and I'd give you at least one random fact that you could share at the Thanksgiving table, and that was that Jingle Bells was actually a Thanksgiving song. It was written in 1857, but it was later prescribed to be a Christmas song. That's not that interesting, but I was thinking if you're having some heated debates around politics during Thanksgiving, hopefully you don't get into that. You guys can stop and throw that out, and maybe even break into song, and maybe that'll lighten the mood a little bit. The other, and if that doesn't work, I got one joke. Monte knows I like to throw out kind of corny jokes, so. Which is a little tough through Teams and Zoom, because you don't really get that feedback, and I can't with the PowerPoint. I don't see faces. But so what did the turkey, or why did the turkey get arrested? I've already messed it up. Why did the turkey get arrested? The police suspected foul play. Okay, all right. So that's pretty bad, probably. So without further ado, I'll go ahead and jump into the content of the meeting. And we really are happy that you guys are here with us today. And I know the weather is nice out there, and everybody's busy, and time is valuable. So we will get through the presentation as efficiently as possible. So I'm going to be discussing internal controls, and then I'll turn it over to Monte for the remainder of the presentation to cover financial reporting and audit preparedness. We wanted to tackle internal controls first because that applies to all organizations. So maybe you're not in a stage where you need an audit yet, but I will say that anything that you apply in the internal controls and the financial reporting sections are just going to make your audit that much easier. I didn't say easy, all right? So I said easier. We try to make it easy, but if you've been through one, it's a lot of work. So during the session, please feel free to chat questions into the chat box, and if you think of one, go ahead and chat it. We'll have some time at the end, hopefully, to field your questions. But if we can't get to all of them, we will send out an email to the entire group and all the participants that addresses the questions. Okay. See if I can get this thing going. Here we go. Okay, so first, I think it's just important that we take a minute and just define internal control and the purpose of internal control. So internal control is really a process, and that's an important word, process. It's used to obtain reliable financial reporting, effective and efficient operations, and to ensure compliance with laws and regulations. And the reason it's a process is because it's ongoing, it's continuous, it's ever changing. So, COVID-19 is a perfect example of new risks that come about, disruptions in the environment. How do you respond to those? We have a lot of clients that decided to use more of an online bill pay system, and in that situation, you have to really assess, okay, who has access, what are the IT controls behind that. So it's a continuous process. And the other part I wanted to mention too is efficient, because I know in the auditor world, we sometimes come in and we recommend a lot of different things, and a lot of times we might get the response of like, that's great if money grew on trees and we could hire all these people and we had all the time in the world to do it. So internal controls really do need to be efficient as well. So it's important to keep that in mind as you go through and think about your own internal controls. And then maybe there's some things you're doing that possibly you don't need to be doing. But really the purpose in a nutshell is really the internal controls. They safeguard the organization, and they further the objectives of the entity. Those, and you'll find a lot of different definitions on Google if you went out there of what internal control is. But really the premise there is it's to protect the organization. Really the other thing that I think it's important to remember is the reputation of the organization. So that arguably could be the most important asset, even though it's an intangible asset of a nonprofit. I'm sure you've probably heard of some big nonprofit fraud leaks over in the past, or reports of nonprofit fraud, and there's probably PR firms that are used for some of these really large ones that try to help with that process of communicating that situation to the donor and making sure they don't lose trust in the organization. I did want to note, if you do a full-blown non-90, there is a question on the non-90 that asks if there have been any material diversions in assets. So the IRS was smart to think about that when the new non-90 was coming out, to say, well, you might try to cover this up and use a PR firm as much as you can, but you can't really get away from it on the non-90. So I just wanted to stress that is you really don't want to be one of the nonprofits that has to check yes to that box on the non-90. Some of you may be familiar with this. This is the COSO framework. This is really the principal framework that's used for internal controls. It stands for the Committee of Sponsoring Organizations of the Treadway Commission. That's probably not a question you'll be asked at your Thanksgiving dinner, but now you know, in case anybody does come up with that question. The five bullets that you see there across the screen, the icons there, are make up the components of the COSO framework. So the first one is the control environment. And really the best way to explain the control environment is just looking at the tone at the top. So what kind of tone does management set? Do they practice what they preach? Are there controls in place that communicate ethical conduct? For most of the organizations that we audit and serve in general, one of the things that we look at is an employee handbook, and if that employee handbook is signed by the employee, because usually it has a code of conduct in it, hopefully, if you have a good sound employee handbook. Risk assessment, this one is usually very informal for our clients. We have to dig deep on this sometimes and ask them questions, because it's not probably too many organizations out there that set up a monthly risk assessment or even a quarterly risk assessment meeting, but we know it happens. We know it happens on a continuous basis. So examples of staff meetings that happen, examples of just communicating with management and department heads. Those are great examples of how you identify risk and what's happening in your operating environment. Control activities, I'll skip that for now because we're going to talk more mainly about control activities for the rest of the internal control presentation. And information and communication is how you identify and capture information and then how you report it back out. So obviously your accounting system is an important part of that process. Monitoring activities is very, very important. So, that could be how management assesses internal controls. So that part of it is really making sure that all the other components of the COSO framework are working. So you might even do a self-assessment of internal control, and that would be an example of a monitoring activity that you would do. If you really want to make your auditors happy, and I haven't had anybody do this, but if you kept a little journal of each of these little components, and throughout the year, kind of document what is being done. We would love that, because when we come in to do the audit, we could say, hey, what did you do for risk assessment? Because sometimes it's not easy to think back throughout the year, all the things that you've done. Actually, come into this session would be a great example of risk assessment, trying to identify things that, potential risk and things you can do to adapt your internal controls. So I just want to talk a little bit about controls in general. As I was preparing for this meeting, I was thinking about preventive controls and detective controls, because when you think about controls, that's really the breakdown of how you can kind of simplify it. You have some controls that prevent fraud from occurring or errors from occurring, and some that detect it. So one of the things I was thinking, just giving some examples of that. I was at the stoplight and looking up and saying, well, you know what, this is a great preventive control. Going down the interstate in the same day, almost getting a ticket proudly, going a little bit too fast, under 80 though. And saying, well, that radar detector, that's a good detective control. But you can look all around, the locks on your car, the alarm system, the locks preventive, the alarm system detective. If you go into Target and you try to get a printer cartridge, sometimes it can be frustrating because you have to get an employee to do that, but that's a preventive control. On the way out, they've got surveillance systems and alarms. That's a detective control. If you have two people that dislike each other in Thanksgiving and you set them in separate rooms, that would be a preventive control, right? So you can look all around and think about preventive and detective controls, and don't be bashful to tell someone, hey, that's a great preventive control. It might seem a little weird in the everyday situation, but I think that it's important to stress there is a cost benefit to every control. So, just as Target has frustrations probably with customers that come in, or customers have frustrations with Target, I should say, of saying, hey man, I got to find an employee, and Amazon probably looks at that and says, well, this is great, we can just sell it online and have it to you in 2 days. But obviously Target, Walmart, they've identified that as those high dollar items as being important enough. So when they do the cost benefit analysis, obviously the benefits of putting those tags on that merchandise is worth the cost. So kind of taking that theory and breaking it down into the financial reporting world, just to kind of communicate, it's not that much different. So when you think about preventive controls, we'll talk a little bit more about that on the next slide, but what they're basically doing is preventing the fraud and lessening the extensiveness of the detection controls. The detection controls, obviously, as we just said, detect the fraud and the error after they occur. With detective controls, they can mitigate weaknesses in preventive controls, and we see that a lot in small to mid-size organizations, where obviously you don't have the optimal segregation of duties. So in response to that, you have to implement various detective controls for management oversight. So the point being here is that preventive and detective measures are really essential parts of the internal control structure. You need them both. Okay, so from a very big picture standpoint, I thought maybe some things that we don't talk about every day, or even throughout the audit for our clients. There's just some things that you could consider to design and implement your internal controls in the optimal manner. So one thing that we don't do a whole lot of is that we don't see a lot of it with our clients is a formal fraud risk assessment. Now there are models that are out there, and I won't get into those models that kind of are more formal about how you go about doing a fraud risk assessment. In summary, I think the best way to look at it is, and the question that we often ask as auditors when we identify risk is, what could go wrong in this situation? So you look at the area and say, what could go wrong? Is that risk significant enough to have a response? And if so, how do we implement a control for that particular risk? So that's we can talk. If you have questions about fraud risk assessment, please email us and we'll get into more details. Written policies. I know a lot of times we encourage clients say, hey, make sure you update your narratives and your policies and procedures. Of course, time is valuable, right? So sometimes it's hard to carve that time out when you're wearing a lot of different hats, especially. So, well, we really appreciate written policies. I'll use one example, which is a whistleblower policy. You might think you're too small to have that as an organization, but I'd really encourage you think about that. I don't know the percentages off the top of my head. I can't remember them, but when you think about how fraud is actually uncovered, I think it's like the low 40. It's like 43% or so is actually through employee tips. And so you might think about an employee hotline, but it's not so much like calling a hotline. It's how do employees respond? Who do they go to? What are the avenues of communication? So IT risk is something that definitely we could do a whole session on this. And I think Matt Dean's on the call. I'm sure he's done some IT, he's done some cyber stuff for us in the past. Not enough time to talk about that, but it's really important that you take that seriously, because there are definitely risks, and especially in the COVID-19 world with more electronic transactions, you want to make sure you understand the risk with that. And then, implementing effective monitoring controls, which we talked about a little bit, the importance of that for management oversight to kind of mitigate some of these control weaknesses due to resource constraints. And we can't have an internal control assessment without talking about segregation of duties, right? So segregation of duties, and found this little cartoon there, and you see these two folks are helping this guy type. So I'd say that's maybe a little over the top, even for an auditor perspective, and probably wouldn't be good for employee retention either if you had that much segregation. But just wanted to go through some of the kind of the concepts of segregation of duties. I think we probably all understand them, but these are the four areas that I think if you think about overlap, and if you think we have any one of these any single employee that does any two of these functions, right? So if somebody is doing the authorization, the custody, and the record keeping, and the reconciliation, obviously that's a huge segregation of duties issue. A lot of times in the disbursements area, this is a good example. We might see the accountant or the controller, the ability to actually initiate the purchase, also the ability to sign the check, the ability to enter the disbursement into the system, and then also the ability to do the bank rec. So in that situation, you definitely have a concern around lack of segregation duties, and that's where your detective controls really need to come into play. And that's the next bullet point there. So just a couple of best practices. Obviously, I'd love to spend Monte knows this is a risk. When you get me going first, I tend to ramble, so I want to make sure Monte has enough time. But I'd love to spend a lot of time going over some of the best practices. But I've just kind of identified some cash receipts and cash disbursements controls that I'll just kind of go through. Hopefully, you're already doing some of these things. But one thing on the nonprofit world, you really want to be cognizant of is the risk of contribution skimming. And making sure that as things are being coming in through the door, that they actually get in the system, because that's difficult to audit. That's difficult to find if you actually don't have it recorded in the system. But some of the other bullet points I just want to hit real quick. Obviously, reviewing donor checks for restrictions is very important. Making your deposits timely. getting your list of donors circulated to the appropriate members of management or even board members. And that's really a risk against contribution skimming. So if somebody is aware that a large gift's coming in, or even just a medium-sized gift, and they don't see it on that report, they can ask questions. A lot of times we'll see the ability to write off accounts receivable or pledges without management approval, which from an accounts receivable perspective, that's creates a lot of opportunity, because as that cash comes in, all the person really needs to do is a non-cash credit to write off that pledge receivable or that accounts receivable and pocket the funds. And there's very creative ways. I know a lot of check writing technologies are out there that where folks can, even though they're not getting liquid cash, they can still find a way to get the cash and put it into a bank, get the check and liquidate it. Reconciling the general ledger to development database. And then one thing I just wanted to hit was just mail opening procedures. And some of you are going to read these bullet points and think, yeah, that would be fantastic if we had 2 people that could do that. And I understand that sometimes there's constraints. A lot of times there's constraints. So in the case when you don't have 2 people, I definitely recommend that mail is open in public setting. That you try to restrict that individual from having access to their accounting and development. So, the receptionist or an executive assistant or someone that does not have access responsibilities, that's who you really want to have in the mail opening process. Restrictively endorsing checks is another thing. I'm just going to go through these pretty quick so I can turn it over to Monte. Authorizing check signers, making sure that the people that have check signing really do need it. So if you can use a treasurer, if they're close by and you don't have to give check signing to your accountant who has ability to do everything else, that's ideal. If not, you can do dual check signing. That's an example. And I know some people would say, well, banks don't look at dual checks, which is signing. It's true. But just that control itself is a good detective control internally to have. Some of these are pretty straightforward, and requiring supervision approval on invoices, and having management or board member review bank statements and bank recs. Cash disbursements, it goes on away. So some of these items, just making sure that you have dual controls over electronic payments, credit cards, uses policy, those types of things. These slides will be circulated, or if you don't already have a copy. So I won't go through each one of these. Payroll edit reports don't get enough attention, I don't think. A payroll edit report shows you source data changes. So if somebody goes in and actually changes the pay rate of an employee, I recommend that payroll edit report get given to or provided to management every payroll cycle. It's an easy kind of low-hanging fruit to knock out. Some of the common errors that we do see, obviously not segregating duties, but not doing it when it is practical. So some cases it is practical to segregate, but we don't see it. Failure to implement effective mitigating controls. Obviously, a lot of folks use online bill pay, and they might, I talked to a while back a controller said I don't have check signing authority, and then as I got deeper into the process, realized they don't have check signing authority, but they have the ability to pretty much write any check through their online bill system without anybody approving it. So be aware of those types of systems. Some of these others I'll just kind of skip through. More you can reconcile to independent systems, whether it's tuition and admissions data, development databases. Independent data is great as a control standpoint, but we don't always see that happening. IT control is not implementing enough IT controls. And then this last slide, kind of close on this one. Some of these are just some common things that we see. I would say that we definitely see sometimes, some excessive workload for your accounting personnel. You're wearing a whole lot of hats. So we look at that too. Do you have enough resources? And maybe that's a conversation you have to go back to the board and have. But one thing I will say, just to kind of tee up Monte a little bit for the audit side, review and approvals of controls is very important to us. So when we come in to do the audit, we might say, hey, did you do your bank statement review? And you say, yes. And we say, well, can you prove it? Can you show us that it was signed off on? A lot of times, oh, no, we don't document that. Well, from our world, unfortunately, we need to see it documented. So as we get into audit preparedness a little bit, that's something just to keep in mind. So Monte, this last slide is just going over some resources for the folks. If you have any interest, I had to put Hanson Weeble on there. We have some diagnostics tools that you might be interested in, but this book at the top is a great resource for board policies if you're interested in adopting policies and if you feel you're deficient there. So, all right, Monte, I think I went over a little bit, so I'll turn it over to you now.
That's okay.
Thanks everyone.
Yeah, so in case people aren't watching the chat, I just want to remind people that we will send out the slide deck because we do have a lot of information here and kind of go over it fairly quickly. So we will send out that slide deck, and also I think a recording of the webinar for those that want it. And again, feel free to put your questions in the chat, and we'll kind of get back to those after the fact, or if you want to email us after the webinar too, that'd be great. So kind of moving to the next topic is in financial reporting, which all nonprofits are going to be doing at a monthly basis and annual basis. And I think the main purpose of financial reporting is to kind of see how you're doing, see where the inflows, the operational performance, and the overall health of the nonprofit. And really, it provides management and governance with have them make informed decisions about operational choices. And that includes some probably the basic reports that you're all used to is the balance sheet and income statement. And hopefully those are comparative in some way, either looking at the prior period or the prior year to date. Kind of get a sense of how you were compared with a prior period. And also on the budgeting side, I mean, it's a good practice to do an operational budget, but then also to go back to it monthly and look at a budget to actual, which would be a detective type control, and kind of see where you are falling within budget and kind of investigate any anomalies there. And then looking at the financial health, but it can go beyond what the standard financial statements are, and a lot of organizations, both for-profit and nonprofit, are kind of adopting key performance indicators, which are essentially just metrics that kind of tell you key things about your operating effectiveness, or if you're hitting certain goals that you've identified for the year. And they can be both financial and non-financial. So on the financial side, it could be just, are we hitting our annual fund goal for the year, or the number of contributions coming in? On the non-financial side, it could be we are hitting this many, or engaging with this many new donors during the year, or possibly we've served this many clients in this period. And so what's important to note there is that a certain set of key performance indicators are not going to be universal for all nonprofits, and there's a lot of different ways to split data apart to get that information, which is becoming more and more a kind of a staple in some kind of reporting, which is data analytics. And some organizations even use dashboards to kind of put all these certain types of key performance indicators or other metrics in one place to kind of get real-time information on a weekly, monthly, annual basis. Other components of financial reporting is keeping tabs on your principal programs and the cost of running them, which I think is helpful for evaluating the effectiveness of a certain program, but also helps with fundraising side as well, where if you can identify to serve one client, it costs us this amount of money, which can be presented in different ways and can be interesting facts, both in fundraising appeals and in the annual report. There may be specific reporting along with certain types of compliance or grant agreements. So it's important to understand what those reports are. How do you capture that information if it's a different type of report, and how do you monitor that report so you're staying within the parameters. And it's also an oversight. It's a detective control, just reviewing financial information. I mentioned the budget to actual review on a monthly basis, but any review of these financial information can lead to questions of, well, why is this balance so high? Or, I mean, it's just a way to look at activity and kind of ask questions about when things aren't looking the way you expect them to. And another type of purpose for financial reporting is forward-looking projection. So a common one is cash flow, projecting out cash inflows and outflows for a given period, 3 months, 6 months, however long, to see if there's any potential operational constraints in terms of cash. And so next, kind of highlighting some common issues in financial reporting. And then, so they're listed here, but we'll kind of go into them a little bit more detail in the next few slides. So the first one is just talking about account structure and kind of getting into the chart of accounts, the listing of all the GL accounts that organizational has in its accounting system, and just making sure there's enough detail there to be able to effectively track program or departmental spending, to be able to track donor restrictions when contributions are received, and also to associate expenses with fulfilling those restrictions. And then also, and those two kind of lead into getting to be able to track the net assets of the organization at any period end. And there's different ways of doing that. A lot of organizations use QuickBooks, which does have a class system to it, where it's essentially any transaction or account balance can be assigned a class that you can name, and that and so if the organization has 3-4 major programs, you could have 3 or 4 classes and assign revenues to that class and assign direct expenses to that class, and help track those restrictions and those net assets that way. There's also something called locations in QuickBooks, which does something similar. I'm not as familiar with that, but I think both can work. And then there are more robust accounting systems that are what we would call true fund accounting softwares, that are just built to handle more projects and just more data. I mean, we have some nonprofit clients that have hundreds of different restrictions or classes or projects or funds, however you want to describe it, and that type of software is going to handle that a lot more efficiently than QuickBooks would. And so the next common error is just on the accuracy side, and Travis talked some about this too, because really internal controls, one of the first thing Travis talked about was the purpose of internal controls, and that's to help with reliable financial reporting. And so if a comprehensive set of both detective and preventive controls are both designed in the system and implemented, then it's going to help put in good information to get out good reporting. So you're not working with the garbage in, garbage out scenario. And so again, so kind of building off of that, it's reviewing the input that goes in, both at the data input level and just the monthly review of balances, and reconciling monthly to work out any reconciliation issues, and really just repeat that process every month and consistently throughout the year to make sure the integrity of the financial information is there. Another key or common error is just the timeliness of reporting. It's as I mentioned, the first thing is like financial reporting is for operational decision making, and if the report for September is coming out in December, I mean, that doesn't help as far as making operational decisions in October and November. And so again, building off of the internal controls, developing a daily, weekly, the monthly duties, and a kind of a timeline of when they're supposed to be done is going to create a more of an environment and create a comprehensive and consistent closing process, month-end closing process that will just help be timely. And part of that is allowing is management allowing the finance team enough time to do that closing process properly, because it does take time. And so not rushing that process, but at the same time trying to make sure that the year-end reports come out about 7-10 days after month end, whatever is comfortable with the organization. And the last common issue in financial reporting is the balance sheet. Just sometimes gets overlooked. I think maybe it's that the income statement is just a little more exciting as financial statements go. It's active, looking at inflows and outflows and performance with other periods. But the balance sheet does I mean, it provides information that the income statement does not. And so it's important to review balances on the balance sheet and be able to know that if there's variances between balances, which there probably are, but do they make sense? And typically we are going, and part of the month-end procedure should be to reconcile the bank account or reconcile the investment account. So you know what those differences are in those kinds of categories, but looking at other smaller accounts that maybe there was an account that didn't change during the period, from period to period, and maybe that's okay, but understanding why that is okay. And then also just to keep tabs on liquid resources, your cash and money that you're owed, so your receivables, and also money that you owe vendors, so your accounts payable, your current portion of debt, and so looking at those some liquidity ratios is also useful. A common one is called a quick ratio, where it's looking at cash plus receivables and dividing that by your current liabilities, so your accounts payable and any current portions of debt. And if that ratio is over 1, then that is going to be a sign that you have enough resources to pay down or to pay your obligations due within a year. But if it's below 1, then you might need to look at something there, maybe cash flow issues. So overall, just don't forget to review the balance sheet and just to make sure. And if it's out of balance, then obviously there is something issue there. So that is definitely a key piece. So that kind of gets through the financial reporting piece. And so the last key, or the last topic we have is just keys to a successful audit. And so we kind of developed these points with a financial statement audit in mind, but really, I think a lot of these pieces, these bullet points, can be applied to other engagements as well. So like a financial statement review or compilation, or even if you hire a CPA to prepare the Form 990, I think it's going to be applicable to a lot of different services. So the first is kind of treat the audit as a year-long process. And so I know that a lot of our clients would rather not think about it that way, but it's really I mean, I'm kind of reaching back to what Travis said multiple times, but it's really just keeping up with the internal controls, making sure you're on top of your financial reporting. I mean, all the things that you should be doing, keeping up with schedules and reconciliations, making sure that you're maintaining your internal control, and the policies and procedures are updated because, as Travis mentioned, we do review those narratives and kind of look at that, and that's how we evaluate whether the internal controls are designed effectively and also are being implemented. And also just being in communication with us throughout the year that's outside the audit. I mean, if there's any unusual transactions or pretty significant transactions that you just want a second opinion on or want us to look at, if we're looking at it as those transactions are happening, and if we need to do any research or look at it any further, being able to do it then instead of during the audit will just kind of make the audit fieldwork a lot smoother and just more efficient. The next is kind of focused on the timeline and tasks. So at the beginning of most engagements, we're going to give you an audit request list of just documents and schedules that we need to complete the audit. And what's important is for you for our clients is to make a plan based on those requests of when does it need to be completed and who's going to prepare it. And it also goes back to communicating with us, because it could be if there's any time that you think you're going to be behind schedule of when that deadline was going to be, then it's important to let us know. And those deadlines, we need to know those too, as far as when we need to be able to have field work done, and because it kind of works backwards of when we need to get a draft for management to review. Will depend on when we start fieldwork, which will depend on when we are able to get those request list items. And that last bullet point is just let us know if you are falling behind, you need help with preparing an accounting schedule of some kind, that we can work with you and provide that accounting service ahead of the audit fieldwork to again make sure that the field work is just for doing the audit and not doing any kind of accounting service related service. And in looking, if this is not your first audit, then it's important to kind of review the prior year results of the audit. And if there was any audit adjustments that we made or suggested making during the year, that kind of look at those and identify what the issue was to just eliminate the reoccurrence of that kind of adjustment. And similarly is just looking at any internal controls that we identified during the previous year audit, and during the next year, kind of take steps to make sure that those internal controls have been addressed. But at the same time, it's that cost benefit analysis that Travis was talking about, whether it's practical to move forward with making those changes or not. The next thing is evaluating accounting estimates. And so accounting estimates, or whenever management has some sort of judgment involved in that calculation or inputs into a calculation, or there's the allocation of certain items, it's important to look at that methodology each year and make sure that it is using current year information that's updated so it's applicable to the year, and just to understand that the prior year methodology may not be appropriate and may need to be changed. Probably the most common example of an accounting estimate is the functional allocation of expenses. So because that's required for audit reporting, but it's also required for the 990 as well. And so all expenses need to be allocated into one of three functional categories. So program services, general and administrative, and fundraising. And there are certain expenses that can be just put into one of those categories, but there's other expenses like payroll, salaries, and benefits, where an employee might be working in working for a program, but also have admin duties. And but those roles of employees can change from year to year. So it's evaluating that allocation methodology each year with current year information, and knowing that you can't just rely on what the methodology was last year. And then also just to document what that methodology is, because that is a key piece for what we're looking at. Is we're kind of evaluating the overall calculation, but then it's kind of using that documentation of what the methodology is as another evaluation tool of the accounting estimate. So seeking clarification. So as I said, we will provide a request list, and we try to be as clear as possible with how we title certain reports or anything. But if you have a question on any of them, just let us know, because I think that saves time on your part, so you're not guessing, well, I think they mean this report, and then we get it and we say, no, we actually meant this report. So ask for clarification, or if you want an example of what the work paper was from the prior year, we can certainly send that to you. So any questions that you have up front on what we need is just gonna help with the audit process going forward. And then I think this is the last one. It's just being available during field work. Just if we have a time frame of when the field work needs to be done, just being available or having a designated person to handle audit requests is just going to make the process go smoother. So for handling questions or asking for additional documentation, it's going to go a lot better if we're not having to ask a question and then wait a couple days, and then pick it back up to continue that testing. So that's an important piece of it too. And then I think this is kind of the last slides here. It's just talking about potential complications. So it's kind of similar topics, similar ideas as what we kind of went through with the keys for a successful audit. But so anytime that if the trial balance or audit work paper is not ready by the requested date, then I mean that kind of pushes back things, unless there's communication on being delayed and kind of planning for that. If the timeline itself just is not realistic, if there's not enough time to get ready for the audit or even do the field work, can push back delivery dates. If we get the current year numbers, and we always go almost straight to the net asset balance that's beginning of the year, and we tie that back to the previous year's audited financial statements, and those don't agree. I mean, we always ask that question, so making sure that those reconcile. Excuse me, a similar point is like if there's in that request list, if we get a work paper that is supporting a balance on the general ledger, but the work paper doesn't agree to what the general ledger says, that just requires us to ask a question. And then if there's any significant or complex transactions that you don't, or the client doesn't ask us about during the year, and then we have to end up researching or make an adjustment during the audit, then that's time that we take away from actually performing the audit to handle those types of things. So that goes again back to communicating with us throughout the year and thinking about it as a year-long partnership with just an annual audit deliverable. And then the last one there, if there's loan covenants associated with debt on the balance sheet, and if you know that the organization is going to be in default, which is not uncommon, to go ahead and request a bank waiver from the lender as soon as possible, because we need to know, in order to finalize the audit, we need to know how the bank is going to handle that before we finalize the audit. So just getting that bank waiver as soon as possible is going to help get the draft audit out in time. And so I think that is the end of our formal presentation, and it looks like we have about 7 minutes if there's any questions. And again, these slides will